The average American is drowning in debt, and the one of the biggest indicators or one of the biggest drivers of what your debt cost of debt is, which is your interest rate, and whether you qualify for a particular loan, depends on your credit score. There's over almost $2 trillion of consumer debt in this country alone. And it's very complex. It's very, very hard to manage. I'll give you an example. The concept of a credit score, which basically tells you what interest rate you get on the loans that you have, is like a black box. Most people don't understand it. I didn't understand it when I first. Yeah, I think the first one is getting a credit card, um, and applying for a credit card. And if you get it, to keep your balance low. So let's say you have $1,000 credit limit. Don't spend more than $100 on it. Keep it less than 10%, and always make your payments on time, right? So that will have two effects. One, it will indicate a low credit utilization, which is less than 10%, and also on-time payments, right? So that's the first thing you can do. The other ones.
Amazing. Well, thank you so much, Reza, for joining me. Lovely to meet you as well. Hello and welcome, everyone. And yeah, I guess, let's start fairly straightforward. Could you just briefly introduce yourself to our listeners? Tell us something about your platform, your work, and also your background.
Absolutely. Waj, it's really good to be here. Thank you for having me. My name is Reza Rahman, and I'm based in San Francisco, California, and I'm the founder of Ava Finance. And a little bit background before I started this company 6 years ago. I am a first-generation immigrant to the United States, originally from Bangladesh. And after I came to the U.S., I went through school, got a job, and started my career, the immigrant dream you have in the U.S. And I, studied engineering, got, as I mentioned, I got a good job coming out of college, then went to business school, and then came to Silicon Valley because that's where all the interesting things are happening. And I have had the privilege of working on some great financial fintech startups since being here. Stripe being the last one that I was at. And my passion has always been about how can technology solve real world problems that changes people's lives. And I have two very good friends. One of them was a neighbor, and this was in the middle of pandemic, COVID pandemic. Everyone's at home, and we were on the phone, and we were like, "Look, we've been at all these tech companies, and we saw, we have amazing jobs, but we had this itch to go build something ourselves." And in 2020, we started Ava Finance, and our mission was very simple. Our mission was to help every person control their finances, starting with their credit, and save money and increase their purchasing power. Very simple. We want people to control their finances and live better. And why did we believe this was a problem to tackle? We believe that this was a problem to tackle because Americans in general are drowning in debt and financial complexity. There's over almost $2 trillion of consumer debt in this country alone. And it's very complex. It's very, very hard to manage. I'll give you an example. The concept of a credit score, which basically tells you what interest rate you get on the loans that you have, is like a black box. Most people don't understand it. I didn't understand it when I first came out. I came out of college, I had a great job, but then they checked my credit. I didn't have any credit, and I had to get my dad's friend co-sign an apartment for me. So these are the complexities Americans are struggling with. And most people don't understand what a compound interest is. If you ask them what their debt is, they'll mention what it is, but what are you going to do about it? Nobody has a plan. And they're drowning in debt. So these financial complexities and these financial issues is having broad-ranging effects from societal to economic and personal. And we wanted to try to tackle this problem, and I believed, that the technology was really there to help solve this problem, particularly when it comes to AI. And I'll just leave it with this. We help people improve their credit score, get to the best credit score possible. And we are then looking to work almost like their agent, helping them monitor their credit score, improve their credit score, and actually then also get the financial products that they want and deserve. and do all of that autonomously, automatically, without the average person having to do work. People are drowning in complexity, as I mentioned before, and we believe that it doesn't have to be that way, and it doesn't have to that doesn't have to be such a big headache for the everyday person.
Wonderful. Well, thank you for that introduction, and maybe just for the benefit of our listeners to begin with, can we briefly outline, understand slightly better what actually credit score is and how? Because you mentioned that you're trying to your purpose of the company is to help people tackle their finances, empower them, and also improve their credit score. So just in a few words, in layman's terms, what does
Yeah,
that mean?
yeah, that's a good question. So just to step back for a second, the context of credit score is that, as I mentioned, the average American is drowning in debt, and one of the biggest indicators or one of the biggest drivers of what your debt cost of debt is, which is your interest rate, and whether you qualify for a particular loan, depends on your credit score. And what is a credit score? A credit score is a ton of data that three credit bureaus, Experian, TransUnion, and Equifax, collect about you. Signals like your loan payments, whether you pay them on time, whether you've defaulted on loans, how many types of credit have you had, how many credit lines do you have, and what is the size of your credit line, etc. And there are many other data points they collect together, and they use an algorithm to determine a score for you, right? And that score will determine what interest rate that you get. What goes into this, as I mentioned, a couple of things that go into your credit score: your credit utilization, how much of your credit you use, the different types of credit you have, your credit history, which is a very big factor. How long have you had credit history? And a couple other factors as well. And they go into this black box called the credit score and the algorithm that determines that. One nuance that's very important to understand: your credit score is not a judgment of whether you're a good person or a bad person, whether you're rich or poor. It just simply takes historical information and determines your risk level. Right?
Okay. And so you mentioned, how much of an interest rate you're going to get on your loan. From my understanding, the interest rate is basically the price of money that is going to be lent to you, and so the better the rate for you, the less you're going to pay for the money that you get. Right?
That's right.
Okay, so one question straight away that I had, and this is a big one for me in particular, because I don't think that many people, at least around me, actually, until they get to the decision to maybe get a house or maybe get a car, they don't actually even consider credit cards. There is a big I know that there was a big, even restraint in my end to begin with when I was starting to learn about it a couple of years back, that, there is this idea that you should not be taking a credit. There is a risk involved, and obviously we're naturally risk averse. So how is there any credit score for a person that never has taken any credit to begin with?
Yeah, good question. These are people who are what's called thin filers. They have a thin file. They don't have lot of information about them. And again, it is not whether this person is a good person or a bad person, a rich person or a poor person. It's simply there isn't enough information about them for the model to create a score for you, and you get penalized. I actually believe that people should have as less debt as possible, and it is a good thing to not have debt. At the same time, there's some fundamental things for which you need credit in our current system. Buying a home. Very, very few people can buy a home with just cash. Very few people can actually buy a car with just cash. So they end up financing it. So if you want to own a car, and in America, people drive because public transportation isn't the best. And everyone, who wants to own a home, they usually apply for financing. And in that case, having a credit file, a healthy credit file, and having a good score is extremely important, because even 100-point score difference, right, 50 to 100-point score difference can be a massive difference in the amount you end up paying over the lifetime of your mortgage, for example. And the banks won't necessarily tell you that because they make more money if you have higher interest rates, right? So it is up to the individual person to go figure that out. And that's where most people struggle because it is a system that was not exactly transparent and it's not easy to navigate.
And on that note, just out of interest, I've noticed when I was researching the Ava's website, and from listening to you so far, it seems to me that the system, the way it is set up currently, is maybe unnecessarily, maybe intentionally complex enough for people to start tripping over before they even get into the game. From my understanding, the mere fact that many people don't know about the credit score until they need it to be good on a good level. Yeah. Essentially means that that trap is set, trap maybe, yeah, whatever, that the potential to stumble is there before you even realize you need to get going. So can you make a case for the benefit of our listeners, especially the ones that have not considering credit scores yet, can you make a case of why they should care now rather than, I'll think about it when I need it?
Yeah. No, the best corollary I give is you don't start going to the gym after you get a heart attack or, you go to the hospital. It's too late. It's financial health and physical health are very, very similar in that sense. So if you wait until you apply for a mortgage, you might have a good score by luck, right? But the chances are that you can always have a better score if you actually focus on it, right? It's just like going to the gym. If you go to the gym, yes, people do get sick, but you will most likely be in a healthier position if you go to the gym and work out and take care, eat better than if you didn't do all of those things. And most people figure this out when they actually get sick, unfortunately, right? And in financial health is the same thing, as I mentioned earlier. And some people a lot of those who have good credit scores actually know about it at a young age. Their parents add them to credit cards. They start building their credit history. They understand the cost. They get financial literacy and education from their parents, right? Unfortunately, many don't, right? And it is luck at that point. And so what happens is they realize it quite late. And by then, it takes time to actually establish this. But apps like ours, like Ava, we try to make it easy, fast, and efficient, but there's no shortcut. And just like getting in good health, there's no shortcut. Same thing with financial health. There's no shortcut. The sooner you start, the better it is.
Okay, and in terms of the I'm thinking, for someone who is considering taking it on, from my understanding, and please correct me if I'm wrong, in the United States, it's very popular to get a credit, a loan, for the benefit of studying. And I'm asking for the benefit of my United States listeners more than myself, because I've not studied in the United States, so I've not participated in that system. Does that loan already puts you on the credit score ladder just by default of having it, or is it actually, is it helping? Is it not? You know what I mean?
Yeah, it's a good question. Actually, having different types of loans is helps, but what actually really helps is not having the loan, but actually making payments towards the loans, because then you're establishing history, and you're establishing that you can take a loan and you're responsible enough to make payments and pay off that loan, which means that you are a good risk for a bank or a lender. What is not good is to take a loan and not pay off the loan. Then you're in trouble, because then what's going to be recorded is that you either defaulted on a loan or you were delinquent, which is a very negative remark, and it will be considered against you. It will really hurt you. So, student loans, for example, the most important factor is that you pay them, make payments on time, and that act of making payments on time is a positive reflection and a remark in your credit report.
Okay, and before we go into slightly, further down some different routes, I'd like to talk about AI, and I'd like to talk about how does debt, in your opinion, impact people's life really. I just wanted to ask, could you give us, maybe for someone who has no idea whatsoever, they've just heard the episode and they know now that they need to start considering their credit score, what are maybe top 3 good behaviors in terms of that credit score that you can start today to improve it?
Yeah, I think the first one is getting a credit card, and applying for a credit card. And if you get it, to keep your balance low. So let's say you have $1,000 credit limit. Don't spend more than $100 on it. Keep it less than 10%, and always make your payments on time. Right. So that will have 2 effects. One, it will indicate a low credit utilization, which is less than 10%, and also on-time payments. Right. So that's the first thing you can do. The other ones is to diversify your credit lines. Right. So you get a credit card, maybe you get a small personal loan, right, or a car loan, and then make sure you pay them off in time and make regular payments and never miss payments. So what you're doing is you're diversifying your credit lines and you're making on-time payments. You have low utilization, on-time payment history, and just keep doing that. And within, depending on where your starting point, you should start seeing results in months. It doesn't have to be years. In months, you'll start seeing some impact and some impact of that good behavior. And then continuing to do that. You can't just like health, financial health. You can't just stop after you're done, right? All right, I got to my score. Now I'm gonna forget. I'm gonna go back to other habits. You just have to keep it going, and also try to keep it on autopilot. I've talked to many of our members. They miss their payments. Oh, I forgot to pay my bill. Well, put things on autopilot, on autopay. Um, Stay on top of things. And these are complex. And that's why we built Ava, so that it makes things easy by having a lot of automated tools that make sure that you don't make those kinds of mistakes, or tries to make sure that you don't make those mistakes. But just keep on going. Don't stop, right? And we see that within, if you're very responsible, do all the right things, you could be right there in the top prime tier of credit scores when you do go to apply for your mortgage or other financial products that you need.
And just to reiterate as well, because this is something that certainly helped me, and I assume it would help as well people wherever they are on the in the world working with the credit score. I was given this advice early on, a couple of years back, that you don't necessarily, I was told, you don't necessarily have to actually be, taking a loan to start making that credit score simply by pushing your debit amounts through the credit card month on month. So for example, what I was advised is instead of doing your weekly shopping with your debit card, effectively taking it from the current account directly to pay, you pay with the card, with the credit card, and then at the period's end, you pay in full that money which you already have. So there is no risk involved, and as long as you keep. So maybe this is that myth busting. It was certainly for me about the risk, right? The greatest risk in this, it seems to me, is people just, as you said, missing the payment, forgetting how to do it correctly, maybe taking on too much debt, and believing that it's a money that, it's out of thin air, there is no price to pay.
But again, these are very good habits. Yeah.
Okay, so
I agree with you. And doing these things really helps. Just small habits, like you mentioned, right? And it is not because, sometimes people ask me, so why do I have to do all these things? Why is the system like this? I'm like, well, we didn't create the system. All we know is what is the best thing to do within the system that we exist.
Wonderful. And I'd like to ask you then, in this idea, right? Because many people, when I talk with people about these things, I often hear that they are scared of debt, they don't want to be in debt, they've been in debt before, and it's been really difficult for them to deal with. Psychologically, it can be quite straining, and I do wonder, have you seen, knowing how the system works, have you seen some ways that one can ensure that this, at least the psychological aspect of this, is mitigated? Because it seems to me that currently, for example, if you do want to take a loan for a house and you don't have that cash, which many people want, you have no other choice but do so. But then that is when you get in debt. And how do you deal with that? Do you have, what is your experience on that? What's your perspective?
Yeah, I think of it in a very simple way. There's good debt, there's bad debt, right? Just like there's good food, there's bad food, right? But we need food, and the way the current system works, most people can't buy a home if they don't have a mortgage. So I always, whenever if anyone's willing to listen, I talk about needs and wants. You should not go into debt for wants. What is wants? Going on vacation, right? Going and buying a really nice brand new car. These are wants, right? And I generally am not a fan of going into debt for wants. But I'm okay with debt for needs. What is a need? You need a house. You need a car to get to work, right? You need a student loan to study, right? So I just break it up, have a very simple model. Don't get into debt for wants. If you do need to get into debt for needs, right? Understand what you're getting into. Be disciplined. Don't go beyond your means. Buy a home that you can that is somewhat below your means, smaller, more modest, um, and only do it because you need it, not because you want it.
And something of a shock came to me, and I don't think the situation is different in other countries as it is in the United States. I've heard that many people don't even have savings on a level that they would take them till the end of the year if they were to lose their job. And so in that kind of position, it's very scary for me to put myself in the shoes of someone who is in debt and yet has no financial cushion, as they call it, in terms of that safe landing or just going through it, right? Essentially, if you have no liquidity, and for listeners out there, the ability to pay for your immediate needs or to service the loan that you've taken on, and I'm rambling kind of, but I'm asking, does your platform, Ava, also participate in helping people to tackle these parts of the financial health?
Yeah, and that's a very nuanced point. And yes, that's part of our vision. We don't do this today because we're still building a platform. We're a startup. We started early, but our overall goal is to use AI and technology to do two things: take stress away from people, and use data and their information to help them make the right decisions, and then do the work for them. Um, about 2/3 of Americans actually live paycheck to paycheck, which means by the end of the month, they have spent most of the money they made. And this is something that you alluded to, right? That you don't have a lot of savings. There's not a lot of cushion. And whenever you don't have a lot of cushion, you have two problems. Your margin of error is very narrow. If you make a mistake, right, it is very costly. The second thing is, which is a good thing, is that if you can find efficiency, even if you can spend $10, save $10, $15, $20 a day in one way or another, refinancing, um, it can actually be meaningful to you in your life. I'll give you an example. On our website, we actually talk about this. If you increase your credit score from, let's say, 650 Vantage to, let's say, a 720, right? That can be potentially, depending on what financial product you get, several $100s per month of savings. Why? Because you get a lower interest rate, right? And you're already in debt. You get a lower interest rate. And let's say you buy a home. That's a 30-year mortgage, right? For 30 years, you're going to be paying that interest rate, right? So there are many ways to actually get better when things are tight. But let's acknowledge that things are very tight for most middle class Americans. And it's a real pressure. It's psychological. It really hurts them. It hurts their future. And it's a really big problem that that's caused by factors that people don't necessarily control.
Okay. So before we go into the psychology part, because I'd like to chat with you about that, I just wonder. You just made me think about this idea. Does in improving your credit score while you've already taken on a loan changes the rules with which you're paying down the loan?
It can if you refinance. So let's say you have a car loan at 15% APR, and your credit score moves from 600 to, let's say, 700, right? You have the opportunity now to go and try and refinance that car, because a new lender will be like, oh, you're actually lower risk. I can give you a lower interest rate, right? And you can bring that APR potentially down to, let's say, 10%, right? So no matter what situation you're in, a better credit score will always save you money, or will almost always save you money, because now you can refinance the existing loans that you have.
And what's the incentive for them? Do you mean that I would go to a different provider of the loan?
Different.
Oh, I
Yeah,
see. And they would take over the loan,
that's
settle
right.
it with the other provider, and that the incentive is they get the client to their.
Yes.
I see. Okay, no, that makes sense. Wonderful. So, in terms of that psychology part, there are many books on personal finance. I've done episodes on quite a few of them, and the one that sprang to mind when you were talking about helping through technology to make those decisions less emotional is The Psychology of Money by Morgan Housel. And the author basically argues that money as dealing with money is primarily emotional. Therefore, for example, the markets are primarily emotional and also irrational. So even though we are, great at calculating all these things, our decision making is not necessarily driven by the calculation. It much more
Yeah.
often is driven by the fear or need or want and so forth. So from that standpoint, how do you think applying that technology would help people to deal with these and ensure that they don't become dependent on the technology? Because this is the part that I'm, for example, discussing with my wife recently about the use of ChatGPT on the daily basis. I am considering whether or not we are becoming dependent on yet another external, algorithm of a
That's a
sort.
yeah, yeah. Here's my thesis around this, Watch. It's that um, finance and money is not easy or simple. If you ask the average person, can you explain compound interest to me? The average person will not be able to do it. And if you ask them, explain how much interest you're paying on every single loan and credit line you have, it becomes very cumbersome. And so what the financial system is today, it is a tax on people who are busy and stressed. And everyone is busy and stressed these days, right? Because one, the math, the complexity is there, but also people don't have enough time. If you add those two together, it's a recipe for people making mistakes. I'll give you an example. Um, in between 2021 and 22, around that time, we had some of the lowest interest rates on mortgages, home mortgages in the United States. While that was happening, there were about 20 to 30 million people who could have refinanced. As you remember, I talked about refinancing. They could have refinanced their mortgage and get a lower payment, but they didn't do it. They didn't even bother doing it because they're stressed, they're busy, and they're not informed. So where technology can come in is not to invent something new. Technology is there to just make people's lives easier. So what software can do is it can compute more and better than most people. That's what, you know. software can do for you. And the second thing it can do, it can always continuously monitor on your behalf in a way that you don't have the energy or the time. One thing we have in our app is that we constantly monitor for better rates on whatever loans you have. Why? Because you don't have the time to do that. Do you have time every hour to go and check all the rates across every single financial product? You don't have time for that. You got a job, you got family and kids and whatnot. So that's the other thing that technology is very good at. And lastly, and this is the frontier of AI that's coming in, technology is actually very good now, is to take all that information, synthesize that to actionable things, and then actually go do it for you. These are called agents. And we're building agentic finance as part of our vision. It's like, let's analyze the information, tell you what's ideal for you, where you can save money, compute that for you because it's very hard to compute by yourself, and then do the work for you with your consent. So that's where I believe finance is going. Um, in again, in California, in America, and I'm sure all around the world, autonomous cars are getting very popular, right? Cars driving themselves and Teslas driving by themselves. Um, the future of finance is also going to be similar. People will have much more data information for things to happen by themselves autonomously when it's in their own interest. So that's where technology and it could come in. Now, I'm totally with you on the concern. It is actually concerning. Do I really want software to determine my financial future? Probably not, right? Do I listen to everything ChatGPT says? No. So we have to be very thoughtful and careful. And I think the balance we have to bring is platforms like us, AI technology, software platforms like us, have to do two things. One, we have to gain the users, our members' trust. So they have to trust us. We have to earn it. It's not just given. And that trust can be broken very easily if you make mistakes, right? So the trust becomes very important, and not everyone's going to have the trust. The second thing we must do is don't take people out of the loop. Keep them informed. Get their consent. Help them and make them feel that they're in control. Don't turn this into, excuse me, don't turn this into a car that cannot be controlled. So bring in the right controls, build trust, but then bring in the right controls. Give people the agency to basically say, you know what, I don't agree with this, stop, don't do this. Get their permission before they can do things. Just make things easier for them, but don't take it completely away from them. Because people need to know that they still control and have agency when it comes to these things.
I understand. So the idea here is that you provide the information and you synthesize and analyze for the benefit of your customers all the things that it might be difficult for them to grasp all together in their limited time and capacity to do so for good reason. It's quite complicated. And then the app or the platform can give them sort of triggers, hints on whether or not this is a good moment to act. So, for example, you gave the time of post-COVID, I assume, 2020 and 2021, just about and around that time. And if at that time Ava was available for people to use, it would be possible for people to get to take advantage of that situation simply by learning about it directly from the app, instead of getting over all their fears and distress and looking into it themselves, which of course is quite taxing, especially if you're facing some greater dilemmas. And the last thing you think about is how to pay a little bit less on your car loan. No, that makes sense, and I resonate with you on that front. That as long as the essence of what we do with those technologies is to inform and better, I guess, equip the person rather than take over the person's agency. That's both ethical and down my street in terms of that's the kind of product that I would use. Something that helps me make my life easier while I'm still in control of my life, and I'm.
And every technology works that way, right? Like your car has an accelerator and a brake, right? You don't want only an accelerator, right? So that's been the story of technology and software and AI, and people who built this and designed this today have to do it with people in mind, not technology in mind. Technology is second to understanding people and their behaviors and the psychology.
Okay, so we've yet again talked on another. We've mentioned a few times another keyword, and you've pointed out yourself that that's not the kind of word that many people will be able to define. So I just wanted to ask you: could you briefly define for us what is the phenomena of compound interest, compounding effect, and how does that affect both positively and negatively? I think this is the biggest mind bender for me when I've understood it in terms of, it can play to your advantage and disadvantage.
Yeah. So if you had to really boil it down, whenever people see an interest rate, right? That interest rate is not the amount that you owe in interest is not a simple number of take the loan and multiply by the interest rate and you have how much you owe in interest. Compounding is actually the interest you pay on the balance you carry on a continuous basis. So every time, every month, the more you owe, the more the interest rate actually compounds. Again, I shouldn't use the word compounds, but it's not a simple interest, it's a compound, and it grows over time based on the balance you have. And that balance, right? The interest rate on that, the interest that you owe on it is calculated depending on the loan on a very regular basis, either daily basis with some credit cards or on a monthly basis, right? So, and the longer you have the debt, the more you actually pay. So it makes sense to actually pay your debt early. I'll give you an example. I've talked to some users of ours who like, well, I bought a car for $30,000. Even though the interest rate was 15%, I ended up paying $20,000, $25,000 on that car. Why? Because of compounding. Because they had a longer time period. They had a 4-month, 5-month, 4-year, 5-year, 6-year duration of the loan. So the longer you have the loan, the more the interest rate compounds. And it's not a simple matter of multiplying the interest rate with the amount you owe to determine how much interest you're going to end up paying. So that's the simplest way I can think of, and I can explain. I think what gets complicated is the math behind it, depending on the type and the agreement you have with your lender. For example, if you miss a payment, they will attach additional fees on top of what you already owe. There are many other factors, and I don't want to go into the legal aspect of it, but just know that for most loans, you end up paying more than you actually think you will.
Sure, yeah, and this is something that I've witnessed firsthand as I was advising, or not really advising, helping my flatmate 2 years back. Figuring out, he was in the process of getting a mortgage for a house, and he got the offer from the bank, I assume, or some sort of a building society, and he was quite surprised about the fact that the amount of the loan on which he was expected to pay in full over a 30-year period was 620,000, I believe, and the house that he was buying was only 230, something like that. So it's 2/3. It's 3 times over the price effectively of the house, and of course this is not it cannot be the simple interest of 15%, because 15% would not be twice twice the whole amount. No, that makes sense.
Yes.
And then
also what happens is, and then when you buy a home, you also have an amortization schedule. So you, in the beginning, you pay more interest than pay down the principal, and it's all just very, very counterintuitive for the average person.
And okay, so from what you've just said, I understood that it's actually quite beneficial if your loan is shorter than longer. Yeah.
Yeah,
So could you
that's right.
briefly explain how can we take advantage of the compound interest, in terms of investments, in terms of savings, in terms of basically playing in this
Yeah.
game of financial life?
Yeah. Yeah. So compounding can also help, in your can work in your favor. And that's usually when you actually are the investor and you invest early. One example is investing for your retirement. In the United States, we have something called a 401k. And I've been contributing to my 401k plan since the age of 22. And that over time has compounded. The compounding effects of investing early is massive. So in the same way, when it comes to personal finance, whenever it comes to debt, I think the question you have to ask yourself is, could I take a smaller loan? Could I take buy a smaller home and take on less debt and invest that money, right, in either the stock market or investments, which then grow and compounding works in your favor, right? And then could you use that then to pay off your loan faster, right? So think about it this way: you take a bigger loan, right, and you're paying it off, so you're paying off interest, but then you're not growing your wealth, right? If you take a smaller loan, invest that money, let that grow, and then let that growth offset some of the compounding that you pay in debt, you're just getting out of debt faster then, right? You own your home faster. I love the idea, like, some people have 15-year mortgages, not 30-year. I love that. That's awesome, right? That all works in your favor, right? And then you can, focus actually building your life and building your financial life versus just always chasing debt. And that's why, it is so important for people to understand these factors because they have a real impact on your life and well-being. And if you do the right things, you can be significantly better off than if you just make those mistakes again and again.
So would you say then, just thinking about like the end goal of servicing the debt, figuring out how to optimize it, is the aim of, for example, Ava platform, is the end goal for the customer to be able to fully pay off their loan as effectively as possible, clear all their debts, and essentially get out of the debt servicing? Or do you think there is an optimal level of credit that one can take advantage of even past that stage?
Yeah.
Let's say, just to take another one.
Yeah, that's a good question. And honestly, it depends on the person and their life goals. And one thing we don't do at Ava, we don't try to tell people what their life goals should be. They decide that, right? Some people want to live without less debt. They get anxiety around it. Other people are like, no, I'm going to have a little bit of debt no matter what, right? Our goal is to just make sure no matter what path you pick, you pay as little as possible in interest and fees. That's our goal, no matter what path you pick, right? And I think that's really the path I've always wanted to take, and I believe that people need to decide what's right for them, and everyone has a different appetite. And technology is not very good at changing people's psychology necessarily. It's just there to help them get to where they want to go in a better, more efficient way.
So the idea here is that in an ideal world, an ideal customer is someone who sees the opportunity to use that technology to their advantage and essentially become much more financially fluent and healthy due to better information, more efficient activity. But it's up to them whatever they want to do about it. If they are chasing a house after house after house, so be it. That's their story. Okay, so let's take a broader look, slightly, maybe zoom out, as they say. And I wanted to ask you in general, because you said that the system the way it's created, it's quite complex, and finance is not the easiest thing to understand. And I do wonder, and this is a very hot topic, I think, on many people's minds these days, as we are, especially if you're at a stage of life as I am, starting a family, getting into the rhythm of the adult married life and so forth, thinking about mortgages and stuff. Do you think the way the system is set up is intentionally so complicated, or did it just become so because of so many different influences? And can we actually make it any better?
So I think it's a little bit of both. And here's why it's a little bit of both. I think the non-intentional part is that the world has moved on very fast. Technology is evolving, data is evolving, different financial products are coming out. There's innovation happening. So there's a complexity in the system that is driven without any intention. Yeah. And there are different regulators, and they're trying to help. Like there was a financial crisis in 2008 in America and around the world, right? A lot of it was unintentional. A lot of it was blind spots. A lot of it was the inability for governments and policymakers to really understand human psychology, right? That's why bank runs happen. So there's an unintentional part of it, right? So things moving very fast, population is growing, new financial products coming out, people's needs changing, mobile technology. There is a lot of other factors that are unintentional and makes everything complex and more and bigger and convoluted. The intentional piece is somewhat unintentional, but it's clear. And that is, what is the purpose of a bank or a lender? To make as much profit as possible, right? And the more people pay in interest, the more money they make. And so these incentives are a little bit counterintuitive. It is not in the bank's interest to give somebody a lower interest rate, right? And so they don't think about the users; they think about their bottom lines. Another example is overdraft fees. For example, U.S. banks made over $30 billion a year just on overdraft fees. What is overdraft? Somebody tried to pull money out of your account based on the bill you're supposed to pay, and there wasn't enough money, and you get charged like $25 for overdraft, right? So banks make a lot of money that way, right? So is it in their incentive? Is it in their interest that is prevented? Probably not, right? So I think that part is intentional. And I think that can be reversed. Honestly, that can be reversed. If companies, institutions, organizations are incentivized on the member and the user's well-being, and instead of only thinking about how much money can we get out of them, right? And I love products that tell me I'm going to save you money. It's a subscription product. I'm going to save you money. It's a subscription product. If you don't like it, you stop using it, for example. And a loan is not like that. Loan is just like, once you get the loan, we're going to make money off the interest that you pay on that loan, right? And nobody wants less interest. So if I'm a lender, I don't want less interest. I want more interest. I want more money. So I think it's both intentional and unintentional in different ways. But in the middle, the average consumer is getting screwed.